Hey guys, welcome back to the channel. If you all have saved some extra cash and are interested in investing, then watch the video all the way to the end, as today, in this video, we'll talk about how to become an investing freak by unveiling 5 golden rules associated with the investment. But before that, make sure to like, comment, subscribe to the channel, and turn on the post notification bell icon to get all the videos on the go. So without any further ado, let's get straight to the video. The secret to economic success is investing. You won't have much to be satisfied of until and unless you reach your financial goals. Naturally, you do not really desire to make an investment, but you require to choose wisely to build your income and achieve financial independence. Knowing the actual price of investing and the strength of low-cost index funds is like receiving a knighthood into a global ethereal army of knowledgeable, like-minded investors. You have brand new gleaming armor to keep the enemy out of your wallets and explicit marching instructions. In the case of a preemptive strike, it wouldn't harm to have some uplifting remarks affixed on the inside of your armor to keep you motivated. Here are some investing rules to guide you. Top 5 golden rules of investment to get super rich. Number 1. Always start early and be consistent. Early investment is essential for accumulating money. When it comes to investment, time is the most potent component. Compound interest has the chance to expand your investments and increase the value of your money. Do not give up if you feel that your investment is falling behind. The ideal time to grow trees is 20 years ago. The second best time is today. You may recall, your money performs magic as compound interest grows tiny, consistent deposits into a sizable nest egg that may be used to purchase financial independence. Your money will put more effort into you the earlier you start investing in commodities. If you begin investing at age 25, it will take just $380 a month over 40 years at a 7% return for you to reach millionaire status by the age 65. You've made a $182,400 total investment and made 7 figures. However, if you waited until you're 35, you'll need to put aside $820 every month, or $295,200 to reach the same result. Additional by $112,800. Of course, investing as much as you can also have an impact. At a 7% return, adding just $1,000 to an account each year, at least at age 25, would result in an extra cash up to $200,000 by the time you are 65, for an incremental $40,000 in investments. Consistency is one of the most crucial investment tactics. You want to make a conscious effort to save money each month for the years ahead. Enable automatic repayments each time you get hired to promote the process simple and eliminate any need for thought. Number 2. Take calculated risks. Investing, not only saving, is particularly mentioned in rule number 1. Savings refers to setting money aside that you don't consume, whereas investing is the act of acquiring assets that can create a respectable rate of return. Inflation causes money to decrease value over time if you save a lot of money, but hold money hidden under your duvet. You must invest if you want your retirement fund to increase. Even while you might be able to transform a $1 investment into millions, this doesn't mean you should spend all of your savings on lottery tickets. You must take calculated chances. The basic rule of thumb is to participate in riskier investments when you're fresh and have a chance to recuperate from recessions. However, everyone has a varied risk tolerance level. Shift a few of your holdings as you get aged to healthier ones with a lower expected interest rate but a decreased risk of default. You're in a good position to identify more danger as your money grows. This means that a larger portion of your overall wealth can and should be allocated to alternative investments like digital currencies, initial public offerings, and unique stock holdings. As we described, after your income has served its flexibility-enhancing function, a decent rule of thumb is to start investing 5% of your net worth in new or riskier asset classes. This method of diversification can hasten your path to financial freedom, after which you have the choice of increasing your reallocation. Number 3. Don't invest immediate cash and not invest in anything you don't understand. Even while investing is crucial, you shouldn't commit every idle dime. You require some cash that is readily available or liquid. Some investments include tying up funds for several months or even years to generate profits, and early withdrawals may result in fees. You want to be free to exit money invested in other commodities like equities to withstand depressions. You don't want to take the chance of being unable to retrieve money when you need it if you will need it immediately, such as to pay your loan next month or your child's college tuition the following year. If you'll need money within the next 2 years, it is best to retain it in a retirement fund rather than spend it. However, if you have a long time horizon, think about investing your money so that it will put more effort into you. You must genuinely comprehend both the risk of damage and the prospective reward before you can take reasonable risks. This calls for you to be aware of the investment's potential for profit, whether it has a track record of delivering on stated returns, and the potential for loss. Sadly, too many investors join bandwagons without fully understanding them. This behavior is what caused Dogecoin, a spoof currency that is made as a parody and was based on a meme, to briefly reach a value of roughly $2 billion. A fact, it should come as no surprise that Dogecoin quickly collapsed. Spend some time studying the facts to prevent heavy casualties when an investment that seems too good to be true proves out to be a bust. Number 4. Don't believe the hype. In the early decades, there have been a few significant price movements or market crashes. There was the Great Depression, Black Monday in the 90s, and the dot-com bubble burst, and the financial crisis in the 20s. The investment community seizes on the series surrounding each of these disasters, igniting panic and sending the populace into a panic over worries about the collapse of our nation or the world's markets. Unfailingly, things then begin to improve, and the investment community lauds the outstanding accomplishments of the government and industry for returning us all to the wealth we have grown to know and enjoy. The universe is in order, and we can resume our posh getaways, expensive vehicles, and posh residences. We wouldn't advise you to disregard it entirely, but you should be aware that it is all the buzz. The worth of your investments is not established by them, just as your greatest and worst days cannot sum up your existing existence. Your task is to just hang on for the ride while making an effort to take in the scenery as it passes between hills and troughs. When things go exceptionally well, don't congratulate yourself, and when they go horribly, don't hurt yourself. Number 5. Diversify your portfolio. Recognizing how investments function as well as making sure you don't invest all your money in one place are both necessary for minimizing investing risks. Even if you might have a favorite firm, you risk losing everything if you invest all of your savings in purchasing its shares, and it turns out that the CFO was a criminal who was falsifying the accounts. Distribute your money over a variety of different commodities to lessen the possibility of significant losses. For instance, you might invest some of your money in well-known American corporations, while also putting money into property investment or emerging economies in the anticipation that, even if some of your assets underperform, others will. Putting your money in the same organization or company can be extremely dangerous and risky, due to which diversity is the best option. Robo-advisors can also assist you in creating a diverse portfolio without your direct involvement. Even though investing carries some element of risk, there are steps that you may do to protect yourself. To spread your investments is a crucial element. The adage, "don't put all your eggs in one basket," applies to finances as well. You've heard it. Your portfolio diversification, or the amount of money you have invested in stocks, bonds, and currency, should establish a healthy balance so you can achieve your desired returns while reducing your overall risk. Having a well-balanced portfolio is one of the cardinal laws of investing. To achieve this, you should diversify your investment opportunities, which can help foster your portfolio allocation and lower the risk on a whole. Different types of investments will perform relatively differently manner over time. As a last thought, I would add that making an investment is not difficult if you get started early, are aware of your options, and diversify your holdings to reduce risk. You may invest a great deal in the proper commodities and boost your likelihood of having a substantial pension pot that will enable you to fully enjoy your elderly years by adhering to these 5 fundamental investment rules. By doing so, well, that was it, and now it's time for me to end up my video. Please like, comment, and subscribe to the channel. And don't forget to click the notification bell icon to receive fast notifications of all my new uploads. We will meet again in the next video. Until next time, stay safe and thanks for watching.